My name is Mark Seymour, manager of the Northstar Income Fund, and I head up fixed income at Northstar. Today I'm going to be giving a brief update in terms of how we see the markets, the turmoil that's been unfolding over the last couple of weeks, and how that's shaping our views and how we're positioning the portfolio. First of all, I just want to say thank you to all the supporters of Northstar and the Northstar Income Fund. Happy to report that performance has been good over the last 5 years. Over the last 3 years, we've generated a return of 8.4% versus a benchmark of 6.3%, and we've done that at a Sharpe ratio of 1. So looking at the current market dynamics and how that's impacting pricing and where we see opportunities, and we do see some quite exciting opportunities unfolding. So first of all, if we have a look at inflation, what's been happening is inflation expectations have been rising rapidly, and that's been causing a sell-off in both the local market and the global market. If we look locally, inflation currently at 3.2%. That's likely to remain at these levels for the next month. And then after that, because of base effects, that's fuel price rises and food, the year-on-year number is anticipated to rise rapidly to 5%, and then within a year to settle back at the 4% mark. And if we have a look in the US, the current inflation is at 1.7%, and for the same reasons, we've got these base effects coming through in conjunction with the vaccine rollout and the stimulus plan. What is anticipated is inflation rising to 3% and then dropping back down below 2%. And what's causing this, or what's exacerbating this dynamic, is during the COVID event, we've had some disruptions to the supply lines, and with the marginal uptick in demand, what we find is that you're having this inflation pulsing through the system. But the important point is that inflation expectations are for inflations to settle back at very reasonable levels. And then if we have a look at interest rates, locally the interest rate, we've got the repo rate at 3.5%, and growth itself, although we're having a rebound, is not anticipated to get back to pre-COVID levels within 3 years. So it's going to take a while for that to normalize. And then at the same time, you've got inflation that's expected to tick up, but to remain well within the target band. And so for that reason, the central bank is likely, and the consensus data is for interest rates to stay on hold for the next year, which is very supportive of fixed bond pricing. And then in the States, we've got the Fed that has stated that they will want to stimulate the economy as much as possible, despite this inflation spike that's coming through. They've changed their monetary policy to accommodate for an average inflation. So on that front, even though the market is testing them currently with higher bond yields, I believe that the US will likely keep rates at low levels for longer than the market is currently pricing in. And then if you look locally in terms of fiscal risks, we've just had the budget in late February, and some positives that came out of that budget was the focus on cutting expenses rather than raising taxes. Also the revenue overshoot that was used to reduce debt. And then also the adjustment to the debt profile was a positive step. The debt to GDP ratio on their estimates is expected to come in below 90% within 5 years. And so I think that as a whole for now has kept the rating agencies at bay. And for that reason, we see the fiscal risks as being relatively well contained currently. So if we stack those three dynamics up, we've got inflation spiking, yes, but coming in back into very reasonable levels. We've got interest rates that are likely to remain on hold. And then we've got fiscal risks that are relatively well balanced. Set against this backdrop, if we're looking at cash, fixed bonds and inflation-linked bonds, what we recognize is that cash is not going to give you a real return. So that's a problem. We're quite negative on cash for that reason. You can get some yield if you go down the credit quality. You may get up to 6 or 7% yields, but you do take on considerable credit risk. Looking at inflation-linked bonds, a lot of that opportunity has been pricing out over the last year. And although we've still got inflation that's spiking up, that value has dissipated quite a bit. The front end of the curve is still great value though. So for that reason, we still hold a chunk in inflation-linked bonds. Then if you look at fixed bonds over the last couple of weeks, those have sold off quite dramatically and now actually represent quite good value, specifically in the front end of the curve and the midpoint in the curve. And so what we've been doing in the portfolio is we've been shifting out of some of the medium-term inflation linkers and into slightly shorter dated fixed bonds, which are offering great value. So how does the portfolio look currently? Currently we have 30% in fixed bonds, which we've been lifting over the last month. We've got 50% in inflation linkers, or just below 50%. So that's actually dropped by about just around about 15%. We've got a small amount in cash and floating rate notes. And then the balance of 13% we've got in global currencies. And with the US curve actually shifting out, we are looking at potentially extending the duration and some of that, those global cash portion. So overall, the fund is sitting on a yield of 6.3%, which in this environment of very low interest rates, I think is very attractive. And on a forward-looking basis, I think the risks are well balanced. We're well within our limits. And yeah, we look forward to generating decent returns going forward.